Okay, today we're going to talk about variable costing. Okay, now before we do that, I want to review some of the previous concepts we learned because it all relates to what we're going to talk about today. Okay, so if we look at the slide, remember product costs. We have three product costs: direct materials, direct labor, and overhead. Now overhead includes both variable overhead and fixed overhead. In fact, that's going to be our primary focus today. Versus a period cost. Now, a period cost are our operating expenses, which you may recall in financial accounting was our selling, general, and administrative expenses. Now, I want you to visualize the income statement, the multi-step income statement. We have sales revenue minus cost of goods sold, which is an expense, and cost of goods sold is where our product costs are: direct materials, direct labor, and overhead. Sales minus cost of goods sold equals gross profit, minus my period costs, my operating expenses, selling, general, and administrative expenses, equals operating income, and we don't need to go any further than that. That's really our focus. Product costs get capitalized. That's an important word in accounting. Capitalized means it goes on the balance sheet, either as an asset or a liability. In this case, it gets capitalized as inventory. Now, you know from previous chapters that we have three different types of inventory in a manufacturing environment. We've got raw materials inventory, we have work in process inventory, and we have finished goods inventory. Okay? So until we sell the inventory that we produce, it goes on the balance sheet. And then when we sell the inventory, it gets expensed as cost of goods sold under the matching principle. Right? We match the expense to the time period that it relates to revenue. Okay? So we capitalize production costs. Period costs always get expensed. They never get capitalized. They never go on the balance sheet. They go straight to the income statement in the period incurred. Okay? And those concepts of product cost versus period cost are the central focus of this chapter. Okay? So I wanted to kind of review that. Now, we said that overhead costs can either be variable or fixed. Variable costs include utilities, indirect materials, supplies. Sometimes companies use what's called units of activity depreciation, which is based on how much you produce, so that can vary. Fixed overhead could be rent, lease costs, property tax, insurance. If you use straight line depreciation, that's fixed. So we have to analyze and really have to split up our overhead costs into a variable and a fixed component. And that's going to factor into how we determine the cost of our product. Okay, now, I've put a bunch of stuff on the board here which I will make reference to. They're also going to be in your slides. So don't feel you have to write this stuff down. It's just for me, for easy reference. You already have these in the slides that you're about to see. Okay, so absorption costing is required under GAAP, generally accepted accounting principles, when we prepare financial statements for external users, the government, investors, banks, customers, vendors, etc. We have to use absorption costing. And the reason they call it absorption costing is that the cost of goods sold and ending inventory will include fixed factory overhead. We're going to absorb it into the inventory and ultimately into cost of goods sold. We're going to compare that to the concept of variable costing. So notice, in the slide we say cost of goods manufactured, which is the cost of the goods we produce, the units we produce, includes direct materials, which is variable. Direct labor, which in a previous discussion we said, direct labor could be fixed, it could be variable, and we decided for exam purposes and for discussion purposes for this class, we'll consider direct labor variable, as an hourly wage would be. But there is discussion on that. That aside, direct materials, direct labor, variable costs. Variable overhead and fixed overhead, notice those are all included in the cost of the goods we manufacture and the cost of goods sold. That's going to be different than variable costing. Okay, now variable costing, sometimes called direct costing, but we'll call it variable costing, only is used for internal analysis purposes. We are not allowed to use variable costing to prepare financial statements for external users. Very important that you remember that. We have to use absorption costing when we release financial statements. But for internal analysis, to see how our costs, if we're operating efficiently, our costs are the same as in previous periods, variable costing can be very useful. The only difference with variable costing is in how we account for the fixed overhead costs. Okay? So in variable costing, we're going to include direct materials, direct labor, and variable overhead in the product cost. Okay? Product cost gets capitalized, and then when we sell the inventory, it hits cost of goods sold. Fixed overhead is considered a period cost or an operating expense in variable costing. That means we expense all of it each and every period. Pardon me, when I say period, I mean monthly, quarterly, annually, however you define your periods, however frequently you prepare financial reports or reports for internal analysis. That is the difference. But as you're going to see, things can get a little bit complicated in terms of when we're comparing our costs and our profits, absorption costing versus variable costing. So we're going to go through a variety of slides, and we're going to look at a few different scenarios to illustrate how variable costing and absorption costing produce different results. Okay, so again, the key thing to remember here, and the primary focus of this whole chapter, is how we account for the fixed factory overhead. In absorption costing, it's part of the product cost. Okay? That means it gets capitalized. In variable costing, it's a period cost. It gets expensed each period. It does not get included in ending inventory, and it does not end up in cost of goods sold. It's further down in the operating expense section. Okay? So we're going to take a look at some examples. Here's a good illustration that kind of shows you visually the difference between the cost included in the product under absorption versus variable costing. Let's do a quick review. I've put these graphs on the board. This was the graph from the chapters on cost, volume, profit analysis, which I believe you've already seen. Or if you haven't, you will see very soon. I don't remember. Variable costs. Direct materials, direct labor, variable overhead. Remember, variable costs on a per unit basis stay the same. And in total, the more we produce, the more cost we incur. Okay? I want to put something on the board. The vertical axis is dollars and cents for all four graphs, and quantity, that's my abbreviation for quantity, is the horizontal axis. Okay? So here's a good example to illustrate how variable costs behave. If you're manufacturing a car, each car needs a steering wheel. Now, we may buy those steering wheels from another company, and we may negotiate and assign a contract. Each steering wheel, we pay $45, $50. So every steering wheel on a per unit basis costs $50. The more cars we build, the more steering wheels we need. The total variable cost increases as production increases. Fixed costs, on the other hand, say you spend $10,000 rent per month for your factory. Well, here's your fixed cost in total. There's that $10,000. Whether you build 1 unit, 10 units, 100 units, 1,000 units, you're still paying $10,000 rent. Now, the more units that we produce, the fixed cost per unit will go down. Using my example, assuming I want to at least break even and not lose money, if I only make 1 unit, 1 car, then that car, the price, has to include $10,000 rent so that I don't lose money. If I can build 2 cars, then I take the $10,000 and I can split it, and each car now only has to have $5,000 of that cost included in the price. If I can produce 10 cars, then $10,000 rent divided by 10 units. Each car includes $1,000 of rent in its price so that I recover my cost. If I can produce 10,000 cars in a month, then $10,000 rent divided by 10,000 cars, $1 of rent included in the sales price. Okay? Which is why companies always like to operate their factories as close to operating capacity as possible. That's peak efficiency. Okay, so on a per unit basis, the more we produce, fixed cost per unit goes down. Fixed cost in total stays the same. So this is, I believe, is a review for you, okay, in terms of cost behavior. And this will factor in to our product cost when we're looking at absorption costing versus variable costing. Okay, now we're going to look at 3 scenarios. Let's look at these together. In the first scenario, the number of units that we sell, or sales, will be the same as the number of units that we produce, and that'll be 30,000 units. Okay, whatever our product is, chairs, computer monitors, coffee mugs, whatever it may be, we're going to produce 30,000, we're going to sell 30,000. In the second scenario, we're going to sell 20,000 units, but we produced 30,000 units, which means we're going to have 10,000 units in ending inventory. Okay? So scenario 2, since we produced 30,000, we only sold 20,000, we'll have 10,000 units in ending inventory. And in scenario 3, we sell 30,000 units, we only produced 20,000 units this period, and we're going to assume that we have 10,000 units in beginning inventory, which is inventory left over from the previous period. And so we sell 30,000 units. This period we only produced 20,000, and we sold 10,000 units that were already in inventory. And notice what it says on the bottom. Based on how much we produce, our cost per unit will be different using absorption costing, which is what we have to use for reporting purposes, but will not be different using variable costing. And this is the benefit for variable costing. Now, this slide right here, which you have, is also the information I put on the board, because as I advance the slides, I'm going to make reference to this information. I believe it'll be helpful for you to see it. Now, if you can print this particular slide and have it in front of you, it'll accomplish the same thing as when I make reference to information on the board. But this information on the whiteboard that I'm waving at right here is the same as the information on this particular slide. Okay, these are the assumptions we're going to make. Sales, $20 per unit. Our direct materials to make one product is $5 per unit. Direct labor is $3 per unit. Our variable overhead is $1 per unit. So notice, our variable manufacturing costs are 5 plus 3 plus 1, $9 per unit. Fixed overhead in total is $120,000. If we manufacture 30,000 units, then 120,000 of total fixed overhead costs divided by 30,000 units, our fixed overhead cost per unit will be $4. If we only produce 20,000 units, like one of the scenarios we're going to look at, then my fixed overhead cost is $6 per unit. And I refer back to this slide right here. Remember? If we produce more, my fixed overhead cost per unit goes down. If I produce less, I go back up, my fixed overhead cost per unit is more. That's going to change my product cost under absorption costing. It will not change my product cost under variable costing because we do not include fixed overhead in the product cost. This 120 under variable costing will get expensed as a period cost each and every period. Whereas in absorption costing, it's going to get included in the product cost, whether it's in cost of goods sold or if some of it may still be in ending inventory. Okay, so this is the information. Now, we said that under variable costing, my variable manufacturing costs are $9 per unit, which again is 5 plus 3 plus 1. Under absorption costing, it's going to be, my manufacturing cost will be 9 plus 4 is $13 per unit, which is over here. Let me step over here. Under absorption costing, when I produce 30,000 units, my product cost is $13 per unit, which again is the 9 plus the $4 of fixed overhead. If I produce 20,000 units, then notice that this will be $15 per unit. That's a 5 right there. $15 per unit, which is the $9 of variable product costs, direct materials, direct labor, variable overhead, plus the $6 of fixed overhead, 120,000 divided by the 20,000 units we're producing this period. That gives me $6 of fixed overhead per unit. 9 plus 6, notice my cost increases when I produce less, from $13 to $15 per unit. So what you may want to do is pause and really try to get a grip on this information, because we're going to be referring to this for the remainder of this lecture and the remaining slides that we're going to see. Okay, so hit pause, rewind, whatever you got to do, and get comfortable with all this information here and my cost per unit here. And notice I put variable cost per unit is $9 per unit at all levels of production. And again, this is the benefit. It's more consistent. Okay? Okay, so in our first scenario, where production and sales are both 30,000 units, we're going to see that whether we look at absorption or variable, our income will be the same amount. And that's because we don't have any inventory to deal with. We'll have inventory to deal with in the other two scenarios, and that'll cause our product cost to be different and therefore our income on the income statement to be different. All right, so let's take a look at this slide here. Notice it says absorption costing income statement when production and sales are both 30,000 per unit. In the data in the previous slide that is on the board, sales is $20 per unit, that's what we sell each product for, times 30,000 units, revenue 600,000. We're going to assume no beginning inventory. And notice I have my cost of goods sold equation on the income statement. That equation is beginning inventory plus cost of goods manufactured equals cost of goods available for sale minus ending inventory equals cost of goods sold. So we'll assume no beginning inventory. The cost of goods manufactured under absorption costing, $13 per unit, which again is my product costs. $9 variable manufacturing plus $4 of fixed overhead. It's $4 because we're producing 30,000 units. 120,000 divided by 30, $4 per unit. 9 plus 4, my product cost under absorption costing is $13 per unit. 30,000 units produced times 13 is 390,000. Don't have any ending inventory, so my cost of goods sold will also be 390,000. Revenue 600 minus cost of goods sold 390, gross profit 210,000. Now my operating expenses, which I put S&A, selling and administrative expenses, is 75,000. How do we come up with that? Well, we sold 30,000 units, and I put on the board here my variable operating expenses, which would probably be selling expenses, commissions perhaps, is $2 per unit. We sold 30,000 units, so 30,000 times 2 is 60,000, plus my fixed operating expenses of 15,000. That's 75,000. My total operating expenses, which are broken down into variable and fixed, okay, the variable portion is $2 per unit times 30,000 units sold, that's 60,000, plus the 15,000, $75,000. And that'll give us operating income of $135,000 under absorption costing. Okay, so $135,000, hang on to that number. We're going to move to the next slide, and we're going to see that the income will be the same under variable costing. And again, when sales and production are at the same level, then they produce the same results. Let's take a look. Now, think back. When we use variable costing, we're going to use the contribution margin format for the income statement, which we use for internal analysis, which we do not use for reporting purposes. Okay? Here is the variable costing income statement using a contribution margin format. Revenue is the same. Now notice, my manufacturing costs under variable costing, we produce 30,000 units. My variable cost is $9 per unit right here. 30,000 times 9 is 270,000. No beginning or ending inventory. Okay, so I have a new term here that we call variable cost of goods sold, 270, revenue minus my variable cost of goods sold produces something called the manufacturing margin of $330,000. It's a new term for you. Sales minus variable cost of goods sold equals the manufacturing margin. Then we subtract variable operating expenses, selling, general, and administrative expense, which is $60,000. Again, $2 times 30,000 units sold, and I have a contribution margin of $270. Okay, now I know this is throwing a lot of data at you, so you want to pause periodically to kind of absorb, if you'll excuse the term there, absorb all the information. Below contribution margin, let's just go back. In its simplest form, the contribution margin income statement, sales minus all variable costs equals contribution margin. Minus all fixed costs equals operating income. So below contribution margin, there's my fixed overhead. Remember, this $120,000 under variable costing gets expensed. It's a period cost. And there's my fixed operating expenses, selling, general, and administrative of $15,000. And this operating income, $135,000, is the same as it was under absorption costing. Why? Because we produced and sold the same number of units. Now, the next scenario, we're going to produce more than we sell, and that's going to generate ending inventory. And so the numbers are going to change a little bit. So let's take a look. The slide we're looking at is absorption costing. Production was 30,000 units, but this time we only sold 20,000 units. So my revenue, $20 per unit times the 20,000 units sold, $400,000. Again, no beginning inventory in this example. Cost of goods manufactured, we manufactured 30,000 units. Okay, so $390, right? 30,000 units produced times my cost per unit of $13. Again, this is absorption costing, so we're including $4 of fixed overhead in the product cost. Cost of goods manufactured, $390,000. Now, I have 10,000 units that are in ending inventory. I produced 30, I only sold 20. I have 10,000 units in ending inventory. Notice, my ending inventory, 10,000 units at a product cost of 13 will be 130,000. And that'll give me cost of goods sold of 260,000. Sales, 400, minus cost of goods sold, 260, gross profit, 140. My selling and administrative, or my operating expenses, I sold 20,000 units at a variable operating expense of $2 per unit, that's 40,000, plus fixed operating expenses of 15, that's 55,000 variable plus fixed operating expenses. Operating income, $85,000. So take note of that, because that's going to be different than this same scenario under variable costing. And what we're going to see is that the difference relates exclusively to the value of ending inventory. And the ending inventory values are different because under absorption costing, we include fixed overhead, and under variable costing, we do not include fixed overhead. So let's take a look. Okay, under variable costing, we produced 30,000 units. We sold 20,000 units. Revenue, 20,000 units, again, times 20, 400,000. My variable manufacturing costs, direct materials, direct labor, variable overhead, $9 per unit times the 30,000 produced gives me 270,000. My ending inventory will be 90,000. 10,000 units in ending inventory at a variable cost per unit of $9, 90,000. Variable cost of goods sold will be 180,000. 270 minus 90 equals 180. My manufacturing margin, revenue minus variable cost of goods sold, equals manufacturing margin of 220. Then I'm going to subtract my variable selling and administrative expenses, 40,000. I sold 20,000 units. Think of a sales commission of $2 per unit. Okay, 2 times 20 is 40,000. Gives me a contribution margin of 180. And again, hit pause if you need to reconstruct the numbers. I know you're seeing an awful lot of data in a short period of time here. Then we subtract all, again, under variable costing, we expense as a period cost all fixed costs. Fixed overhead 120, fixed operating expenses of 15. Okay, 180 minus the fixed costs will give us operating income of 45,000. Now I'm going to go back to the previous slide to show you that under absorption costing, my operating income is 85,000. Okay, I'm going to go back now to the variable costing slide. Okay, so 85,000 for absorption costing and 45,000 under variable costing. 85 and 45, the difference is $40,000. Okay, and you can probably construct what that $40,000 is. It's my ending inventory, 10,000 units, and the difference in the value of ending inventory relates to the $4 of fixed overhead under absorption costing. That $4 is included in the value of ending inventory. That makes ending inventory higher, right? Under variable costing, it's excluded, so ending inventory is lower. Now think about this for a moment. Cost of goods sold is reduced by ending inventory. Remember, we subtract ending inventory from cost of goods available to get cost of goods sold. If ending inventory is higher, as it is under absorption costing, cost of goods sold will be lower. If cost of goods sold is lower, then when sales minus cost of goods sold, if cost of goods sold is lower, my income will be higher. And it is under absorption costing because the fixed overhead costs is included in ending inventory. That makes ending inventory higher, cost of goods sold lower, and operating income higher. So when we produce more than we sell, operating income will be higher under absorption costing than it is under variable costing. Okay, we're going to summarize these differences in one of the last slides. We have one more scenario to look at, and this one's probably the most complicated. Under the third scenario, production equals 20,000 units for the period, but we sold 30,000 units, and we're going to assume that we had 10,000 units in beginning inventory from the previous period, right? Last period's ending inventory becomes the following period's beginning inventory. Now, before we look at the income statement, I want to go back to the board here. I only produced 20,000 units this period. Under absorption costing, my product cost would be the $9 per unit plus $6. Where is it? $6 per unit right here, because that fixed overhead of 120 is getting distributed over fewer units. So 120 divided by 20 is $6 per unit. And again, remember, fixed cost on a per unit basis. As we produce more, the cost per unit goes down. If we produce less, the cost per unit goes up. 9 plus 6, my cost per unit under absorption costing is $15 per unit. So let's look at the income statement. Revenue. We sold 30,000 units at $20 a piece. That's $600,000. My beginning inventory, using the same data as from the previous period, 10,000 units. Last period we produced 30,000 units. We assume that the cost per unit was $13 per unit. Okay, so my beginning inventory is worth $130,000. 10 times 13. My cost of goods manufactured this period is $300,000. I produced 20,000 units. Under absorption costing, the cost to produce each unit is $15 per unit because I produced fewer units, more fixed overhead in the cost per unit. 20 times 15 is 300,000. Beginning inventory plus cost of goods manufactured, cost of goods available, 430,000. No ending inventory, so my cost of goods sold is also 430,000. Revenue, 600, minus cost of goods sold, 430. Gross profit, 170,000. Then I subtract all of my operating expenses, variable and fixed. That's 75,000, same as previous slide. My operating income under absorption costing is $95,000. $95,000. That's absorption costing. Now we're going to look at variable costing. Okay, we produced 20,000 units. We sold 30,000 units, which means we had 10,000 units in beginning inventory, which were also sold. My revenue, 600,000. Again, 30,000 units sold times 20. My beginning inventory under variable costing, 10,000 units at a variable cost per unit of 9, right here, 90,000. Variable manufacturing, I manufactured 20,000 units times $9 per unit, my variable product cost, 5 plus 3 plus 1. Notice it's consistent each period. It doesn't fluctuate like it did under absorption costing. Beginning inventory plus variable manufacturing costs is 270. Since I have no ending inventory, variable cost of goods sold is 270. Manufacturing margin, again, sales minus variable cost of goods sold, 330. Then I subtract variable operating expenses, selling, general, and administrative. I sold 30,000 units. Variable operating expenses, $2 per unit. That's 60,000. There's my contribution margin of 270. Then I subtract all fixed costs. In variable costing, all fixed costs are period costs. Fixed overhead, 120. Fixed operating expenses, 15. That's 135. 120 plus 15, 135. Operating income is 135,000 under variable costing. I'm going to go to the previous slide to compare my operating income. On the previous slide, absorption costing, operating income was 95,000. Okay, going back to the variable costing slide, operating income is $40,000 more, 135,000. That 40,000 should sound familiar. It has to do with the beginning inventory, including that additional $4 in absorption costing, right? 13 versus 9 per unit times 10,000 units. So beginning inventory has an additional $40,000. Beginning inventory plus your cost manufactured goes into cost of goods available. We had zero ending inventory, so my cost of goods sold under absorption costing is $40,000 higher because of the beginning inventory. If cost of goods sold is higher, my profit will be $40,000 lower. 95 under absorption costing versus 135 under variable costing. Again, a lot of data being thrown at you. You really got to break this down and take it slowly. So hit pause, rewind. You're going to have to review this a few times. Now, I want to kind of summarize some of the conclusions we're going to make. Let's take a look. This is an important slide. If units produced equal the same number of units sold, then the income under absorption costing will be the same as under variable costing. Units produced equals units sold. Income is the same under both methods. If the units produced are greater than the number of units sold, that means we're going to have ending inventory, then income for absorption costing will be greater than income for variable costing. Why? Because ending inventory under absorption costing includes fixed overhead, therefore it has a higher value. When we subtract ending inventory from cost of goods available to get cost of goods sold ends up being lower under absorption costing. Sales minus cost of goods sold, profit ends up being higher under absorption costing. And then the last scenario is when units produced are less than units sold, income for absorption costing will also be less than income for variable costing, and that had to do with the beginning inventory. That additional $4 per unit under absorption costing gets included in cost of goods sold. Cost of goods sold higher, profit lower under absorption costing. So you really have to look at all three scenarios together. And that's what this very last slide is. Now, I don't know if this last slide I'm going to show you right now, okay, it might look like microscopic data, but all I've done is, this is a spreadsheet, and hopefully you can print this thing and maybe enlarge it. But even if you can't, all I've done on this slide is I've taken on the top absorption costing, and I have 3 columns for the 3 different scenarios. Absorption costing income statement on the top, variable costing income statement on the bottom. In the red ink is all of this data. So on this slide, you literally have all of the information in one document that you can then look at, and this is for ease of comparison. Okay? Hopefully you can produce this thing. If you can't, you have all this information. Just print all your slides, maybe tape them together, and you can kind of reconstruct this thing. Okay? So hopefully you can figure out a way to enlarge this and then print it out, perhaps transport it over to Excel and do something with it. But this just simply summarizes all the information that we have. Now I want to make a comment before we wrap up. Going back to the previous slide where we show our conclusions. One of the problems with absorption costing is that a manager can manipulate inventory levels, and as a result they can manipulate what their profits are. So a manager might get a bonus or a commission based on what operating income is. Well, one thing that he can do, which isn't good for the company, is he can intentionally build or manufacture more inventory than we can sell. That's going to increase my ending inventory levels. Ending inventory will be higher. Cost of goods sold would be lower. My profit is higher now. I can increase my profit by manufacturing more inventory. That's manipulating the company for personal gain. That's a conflict. That's a problem. And that variable costing, that won't happen. That's one of the benefits for using variable costing, is that that type of activity won't happen. It wouldn't make any difference to the bottom line if you elevate your ending inventory. And it all has to do with how we account for the fixed factory overhead. Okay? So in conclusion, I want you to memorize this slide here where we talk about when income is the same under the 2 methods or when it's more than or less than. Okay? And review this information. And again, we have to use absorption costing for external financial reporting, but for internal analysis, variable costing can be very useful to analyze what our cost structure is without fixed overhead kind of distorting what it actually costs me to produce. Okay? And we saw that over here. And again, it has to do with my cost behavior. All right? So that is the primary focus of this chapter.